America's economy just flashed a warning sign, and this time, it's not the stock market. The real concern is happening inside US government bonds, the system considered the backbone of global finance. For the first time since 2007, just before the global financial crisis, the yield on America's 30-year Treasury bond surged above 5%. That may sound technical, but here's why the world is paying attention. When investors buy US bonds, they are basically lending money to the American government. Normally, US bonds are seen as the safest investment on earth. But now, investors are demanding much higher returns before they're willing to lend money to the US. Why? Because America's debt has exploded past $36 trillion, and fears are growing that Washington could borrow even more through higher government spending, tax cuts, and rising interest payments. The more debt the US creates, the more bonds it must sell. And if investors start losing confidence, the government has to offer higher yields to attract buyers. That creates a dangerous cycle. More debt, higher interest payments, even more borrowing. And this doesn't just affect America. US Treasury bonds influence everything globally, from mortgage rates and business loans to stock markets and emerging economies. When US yields rise sharply, global money often leaves developing countries and flows back into America for safer returns. That can weaken currencies, pressure stock markets, and make borrowing more expensive worldwide. Some analysts are now asking a serious question. What happens if the world slowly stops seeing US debt as completely risk-free?